Let's get your week started. Live from New York City this morning. Good morning, good morning. Equities positive by 0.3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, Chair Powell's next meeting just around the corner as investors wait for one last read on U.S. inflation. Goldman looking for the rally to broaden beyond tech. We begin with the big issue, a pause, a skip, or a hike. Morgan Stanley's Ellen Zentner looking for a pause. We see a very high bar for the Fed to resume hiking and continue to expect it to be on what they call an extended hold. Bank of America's Mike Gaiman leading towards a skip, calling it a close one and expecting upward revisions to growth and inflation forecasts, a lower unemployment rate and a higher projected policy rate. As for Citi's Andrew Hollenhorst, he is sticking with his call for a hike, writing that those forecasts should lead to higher rates. He says the most straightforward action to take when acknowledging rates should be higher is to raise them. Mohammed Al-Aaron of Queen's College, Cambridge, suggesting the week begins tomorrow.
Tuesday, Wednesday is going to be probably the most interesting 24 hours, a little bit more, 36 hours that we've seen for a long time. A top Fed official guided us to expect a skip, and that will make sense if Tuesday's inflation data comes in well below forecast. They're going to skip now and hike after that.
Joining us now to discuss JP Morgan's Mira Pandit, Nuveen's Anders Persson. Mira, first to you. We've got pause at Morgan Stanley, skip at Bank of America, hike at Citi. Where are you and the team now?
Fed speak has been pretty clear about pausing for the course of the June meeting, but I think by the time we get to July, the Fed may not have the data in hand in order to continue hiking. If we think about the CPI release we're going to get later this week, it's likely to drop to the low fours on headline CPI. And if we think about May and June CPI last year, by the time we get that June print, which the Fed will have in hand for their July meeting, that could drop below 4%. So I'm not sure that the data is going to support further hikes at this point.
Anders, are you looking for the same thing?
Yeah, we're also expecting that it's not going to be a hike this week. I think they're going to hold the rates where they are and really kind of focus more on, we'll call it kind of hawkish skip or hawkish pause. I think there's going to be more focus around the summary of economic projections, maybe more hawkish dot plot. I think they're going to use the press conference to kind of signal things that way, but to leave rates where they are right now.
Well, you saw what Mike Gaiman of Bank of America said, Anders. He thinks there's reasons for upside risk here, expects unemployment to be revised lower, expects growth to be revised higher. Do you expect that median dot to shift higher too?
Yeah, I would say I concur on both those kind of statements. You know, the Fed has a 3.6% kind of expectation for core PCE by year end. I think that seems very unlikely that you know should be going higher. And the unemployment rate, they have a 4.5% by year end. That seems unlikely where we are at 3.7. So that's going to likely be adjusted. So probably both will be moving closer to 4%. And we do get these updated dot plots. We really just need three members to kind of move that higher. So there's a possibility here that we see a shift in that perspective as well. So that's again where I think it's going to have this hawkish kind of feel to it, at least from a headline perspective. And then Chair Powell can kind of use the press conference to manage that as best as he can.
Amira, pretty clear from what you've indicated that you don't think the data supports a hike in July. How will you square that with what most people expect from projections on Wednesday?
Well, we're likely to see a higher median dot simply because the Fed wants to preserve optionality. They don't want to signal that this is a permanent pause. So I think that we will see dots move a little bit higher. We'll see a shift in the projections overall from an economic perspective, moving to be a bit less bearish, again, to preserve that optionality and allow them to be data dependent. But I think the reality is there's not that much that the very blunt tool of interest rates can do for inflation at this point. It's not that sticky inflation is behind us, but if we think about services inflation where it's stickier, rents in particular where it's stickier, services is not that interest rate sensitive. So if the Fed hikes rates, you're not going to cancel your dinner reservation, you're not going to cancel your vacation. While rents are more interest rate sensitive, we're in this odd period where we don't have enough housing stock. If you have a 3% mortgage, you're not going to want to move for a 7% mortgage. So actually, the higher rates move, that actually puts more upward pressure on rents. So I wouldn't say that the inflation problem is solved. I'm not sure that rate hikes are going to do that much additionally to help that sticky inflation.
Are you suggesting then this Fed needs to tolerate higher inflation then, above target inflation for longer?
The best policy prescription at this point is patience. I do believe that inflation will dissipate over time. It's going to take a while to get from, call it 3.5% inflation midsummer to 2%. It probably will require a recession. But at this point, the Fed is fighting against massive fiscal stimulus that is still playing out with the consumer. The consumer has softened, but not particularly weakened. So I think that the Fed very much has to be patient at this point because inflation is usually the last shoe to drop.
And is this patience the new transitory?
Yeah, I mean, I really do think that the Fed ultimately wants to buy itself a fair amount of time here. They really want to kind of try to make sure that they have some time to assess the impact of the previous rate increases, even maybe the banking stress on the wider economy. And I think, really, while we're hearing this skip kind of type term, I think they prefer a pause, but I think they really fear that if we call it a pause, the market is immediately going to read into a cut kind of type scenario. So I think that's why the skip kind of type term is becoming a little bit more mainstream. But all in all, yeah, I mean, I do think that the Fed really wants to buy itself as much time as possible, really kind of assess the data here in the coming months. I do think that July is a live meeting, though. I think the market may be a little bit aggressive in the pricing of around 75 to 80% kind of chance of a hike. That seems a little bit aggressive, but nonetheless, they're going to be data dependent. They're certainly going to be assessing kind of the new data that's coming out. Both obviously CPI tomorrow, but between now and then, I think they're going to be laser focused on what those numbers look like.
Anders, what does data dependence even mean anymore? Do you even think that the data tomorrow morning could move the dial on what they might do on Wednesday? And if it doesn't move the dial at all, even with an upside surprise, then how are they still data dependent?
Yeah, I mean, I think it's a great question. It's a tricky one for the Fed and for the markets, quite frankly, more broadly. I mean, I do not think that the core CPI or the CPI number tomorrow will kind of change the Fed's mind. I think they're pretty set on leaving rates alone. I mean, potentially if the core CPI, which is expected coming in at 0.4, if it comes in materially higher, maybe that has a slight chance of influencing things. But I think, kind of composition will be more key to that, really making sure you understand what's going on in terms of some of the stickier parts. That super core number that Chair Powell continues to refer to, I think that's going to be the one that he and the team continues to focus on. So, I mean, to answer your question, I think, yeah, data dependence is very, very tricky, but that's pretty much all they can do at this point. I think that's what the market's going to have to continue to assess. And given the lag effect, given everything that's going on, we have to continue to really review what the data shows us and react accordingly. And I think that's the tricky part of investing right now. There's so many cross currents, so many crosswinds going through that we have to at least look at the data and making sure that we're processing that as much as we can.
If in doubt, preach data dependence, even if that phrase becomes increasingly meaningless over the last few months. Depending on interpretation, of course. We are about 22 minutes away from the opening bell. Equity futures are just about positive. After that, it's on to CPI tomorrow morning. It's on to the Fed. It's on to the ECB. It's on to the BOJ. Mike McKee, busy week ahead.
It's a very busy week, John, and I would say today's a good day to stretch those trading fingers. Get yourself ready for the next 4 days because it's going to be kind of crazy out there. We do start tomorrow with CPI, 8:30 New York time. That is going to be maybe definitive for the Fed. We'll have to see. The CPI is usually well forecast by economists, and they do think it is going to come down some. So a lot will depend on whether they're accurate or not. We also get the NFIB small business numbers, and we'll see what they say about business and about credit, whether they're having any problems with banks. On Wednesday, of course, is the Fed meeting and the PPI. Thursday, the ECB steps in, and there's a lot of talk about the People's Bank of China cutting rates on Thursday, only a little bit, but it would shake up the global idea of continuing rate rises. Retail sales in the United States, jobless claims, and several other indicators. Thursday's a really big day for a lot of numbers. Friday, we get the Bank of Japan. Will there be any hint about ending yield curve control, also the University of Michigan numbers here. I want to go back to the CPI for just a second. You can see what's going to happen tomorrow. Base effects. A year ago at this time, CPI was really, really high, reached its peak, and now it's come down, which means it would take a lot more to push it up, which is why analysts think that we are going to see a drop in the year-over-year numbers. If not, maybe the folks at the Wall Street Journal get that phone call from Jay Powell to hint at what's going on. Leaves us all with this, John. Friday questions. What's next for the Fed? Have they raised? Have they skipped? Are they signaling a pause? And what are the odds of a U.S. recession? We get a lot of U.S. data this week. Any sign of a rate pause from the ECB? There are questions about how far they want to go. And then does the BOJ, as I said, signal a retreat from yield curve control? The odds are, according to economists, they don't. But just imagine having to deal with that on Friday morning after everything else that we have gone through.
What a week coming up. Mike McKee, appreciate it, sir. Thank you. David Kostin of Goldman already making his move this week, raising his S&P 500 year-end price target of 4,500 from 4K previously. They say prior episodes of sharply narrowing breadth have been followed by a catch-up from a broader valuation re-rating. This is the month-to-date market performance right now for the month of June. Just looking at a range of indicators at the moment. The Nasdaq is up about 2.5%. Massive outperformance on the Russell, up 6.6. That right there is the KBW Bank Index. The KRX is absolutely flying. The KRX is absolutely flying month to date at the moment. And that's asking a lot of questions about what's next. Stuart Kaiser of Citi. Our sense is the move is more driven by short covering than adding longs. Economic growth is likely a necessary condition for a sustainable rotation into cyclicals. Mira, I wanted to come to you on this. We're starting to see it happen. Just the equity markets start to broaden out away from mega cap tech. Is that a rotation or just repositioning?
It's a bit of repositioning on the margins. We are still likely headed towards an economic slowdown, so we want to be mindful of not leaning too hard into cyclicals at this point. But there are these two different stories going on in the market. The big rally that we've seen in mega cap tech and the rest of the S&P, call it 490. And what we're seeing here is that, look, everything's coming up tech when we think about better than feared profits. We think about a potential pause from a rate standpoint. We think about how resilient that could be in a recession and some of the longer term tailwinds from AI. But if we look at the rest of the market, we're actually seeing fair valuations, and we don't have quite the same concentration issues that we have in tech. So we do want to be selective in the rest of the market, but I'm not sure that there's a huge upside catalyst. So it's really about stock picking in this environment as opposed to diving into the rest of the market, expecting a huge leg up.
Mira, how helpful is history right now? I can bring you two quotes that I've basically read in the last 48 hours, the last few days. One from Bank of America's Savita Subramanian, another from Daryl Cronk of Wells Fargo. It's both offering historical analysis, and I'm not sure how helpful one is or the other. This from Savita: bye-bye bear, the bear market is over. 90% plus of the time the S&P 500 rises over the next 12 months after recovering from a bear. And then I get this from Wells Fargo and Daryl Cronk. On average, history shows the S&P 500 doesn't bottom until 6 months after the first Fed rate cut. Mira, is history helpful or just really confusing right now?
It's a bit confusing. I think what we need to remember is the basic dynamic that markets are forward-looking and do price in a range of potential outcomes. And 2022 couldn't be a worse year in terms of thinking about some of those bad outcomes, whether it's the recession talk for the last 18 months, the continuing of Fed hikes. But I think that where we are today is one in which we don't see a huge leg higher in markets at this point. We need to see different sort of upside catalysts come to bear. But at the same time, we don't necessarily need to retest those lows. I do think a lot of the bad news is priced in. Maybe not all of it. We could see a bit of a pullback from here in the second half of the year, just given the strength of the equity markets over the first 6 months. But nonetheless, I don't think that we need to experience a new market low because so many of the risks at this point are pretty well understood.
Anders, you think we should shift focus to recession woes? What does that mean for the people who have been focusing on recession woes for the whole of this year so far and missing out on massive moves elsewhere?
Yeah, I mean, I think it's an assessment of upside downside risk to a certain extent. I think at this point, as we're getting closer to the Fed hiking cycle being probably close to over or nearly over, I guess that's, remains to be seen for sure. I do think that the market will start kind of focusing and shifting their focus a little bit more towards recession and obviously path of inflation, job markets, what have you. But nonetheless, I think we have to be a little bit more realistic that at some point, later in this year or early next year, there's going to be at least a concern around this recession. I think some of our models are showing probably around 55 to 60% of a recession. We don't think it's going to be particularly severe, probably more in the mild case. But at this point, I think the markets, are still looking at the short-term kind of type environment. And quite frankly, there is definitely some tailwinds from that perspective that we're looking at some of the historical kind of type outcomes when the Fed stops hiking. Usually markets continue to hold up particularly well, and fixed income in particular. And therefore, if you add that as well, the fact that technicals, particularly on the fixed income side, continues to be quite strong. There's so much cash on the sidelines that investors are really kind of itching to get back into the markets. And I think that backdrop will be quite positive here in the near term. So it's a tricky kind of timing perspective. I think for the next few months, we have, quite some confidence here that things will hold up. But as we look into the, later in the year, that recession concern is going to start kicking in and looming further and further.
Anders Persson, Mirror Pandits, the two of you. Thank you. Going into the opening bell about 15 minutes away. Let's get you some movers. Here's Abby.
John, let's start out with the shares of Carnival because they are popping sharply higher on an upgrade from JP Morgan to overweight, plus the bank raising its price target to 16 from 11, along with some of the other cruise line operators saying that there's good momentum there and continued solid demand. Novartis is buying early-stage biopharma company that focuses on kidney disease for up to $3.5 billion, or about $40. So shares are close to there, heading to their best day since the IPO back in 2015. And then Nasdaq, not so much. Those shares down about 11%. They're buying financial software maker Adenza from Thomas Bravo for $10.5 billion. Nasdaq wants to build out their software business. Investors apparently don't think it's the best idea. That stock heading toward its worst day since March of 2020.
Abby, thank you. Coming up on this program, Donald Trump pushing back.
Witch hunt, scam, hoax. It's called election interference, and they're doing the best they can with it.
The latest developments out of Washington, D.C. up next.
Witch hunt, scam, hoax. It's called election interference, and they're doing the best they can with it. They've launched one hoax and witch hunt after another to try and stop our movement and thwart the will of the American people. The ridiculous and baseless indictment of me by the Biden administration's weaponized Department of Injustice will go down as among the most horrific abuses of power in the history of our country.
Former President Donald Trump defending himself against the historic federal indictment filed against him regarding his handling of sensitive government records. William Barr, who served as U.S. Attorney General during his administration, has a different view on things.
I was shocked by the degree of sensitivity of these documents and how many there were, frankly. And I think the counts under the Espionage Act that he willfully retained those documents are solid counts. Now, I do think we have to wait and see what the defense says and what proves to be true. But I do think that even half what Andy McCarthy said, which is if even half of it is true, then he's toast.
Toast or not, so far the Republican frontrunner is weathering the storm in the eyes of the public. Asked whether the charges unsealed Friday influenced their view of the former president, 61% in a CBS News YouGov poll said it wouldn't, and 76% of likely GOP primary voters are concerned that the charges are politically motivated. Bloomberg's Anne-Marie Kelly Lyons join us now from Washington, D.C. MH, what's the latest?
Well, Jonathan, the latest there is that as we gear up to see what happens tomorrow with the president going to be in Miami, I know Kayleigh will be alongside with him as he faces these unprecedented charges, is the politicalization of all of it is the fact that we are in a primary race to see who will become the Republican candidate for 2024. And even with these charges, 37 charges, they are very serious. His own attorney general on Fox News Sunday called them damning in this indictment. The fact of the matter is, when it comes to a primary election, if it was held today, it would go to the former President Donald Trump, regardless of his legal troubles. The issue, of course, they have, Jonathan, which some in the Republican Party are speaking about, either whispering behind closed doors or out loud, is the fact that what does that mean for a general race? Maybe he gets the primary voters, but that certainly changes in November of next year.
Kelly, you'll be there, as Anne-Marie indicated. Walk me through what tomorrow morning is going to look like.
Well, President Trump is actually flying from New Jersey down to Miami today to prepare for this arraignment, which will be taking place at the federal courthouse at 3 p.m. tomorrow. It is unclear if we will actually see the president walking into the courthouse or if he's going to enter from underground. But once inside at this arraignment, he will be fingerprinted. He will have his mugshot taken, and then in theory, he will be on his way, at which point he will fly back to New Jersey to speak at his golf club there tomorrow evening and talk to donors. So it becomes a question of whether this really is just another opportunity for him to galvanize the support of his base and raise money, like we saw with the previous indictment that happened in Manhattan earlier this spring related to hush money payments made to Stormy Daniels. Another thing that I would say is that in that Manhattan case on the day of his arraignment, there was a lot of concern about security, the idea that if supporters showed up to the courthouse potentially could incite violence. And we do understand that there are intensive security preparations underway in Miami now, prepared for anyone who may show up and disrupt activity tomorrow. Of course, over the weekend, we had some incendiary comments coming from Carrie Lake, for example, an Arizona Republican, saying anyone who wanted to get to the president was going to have to go through her and 75 million Americans like her, indicating that the majority of those are members of the NRA. So that is something we'll all be on watch for tomorrow, John.
Kelly Lyons, looking forward to your coverage. Likewise with you, Anne-Marie. MH and Kelly Lyons down in Washington, D.C. Coming up, the morning calls, and later, adding duration, staying up in quality and going global. Allspring's George Bory discussing the key investment strategies. That conversation still ahead. Your opening bell, 7 minutes away. 5 minutes away from the opening bout this morning. Good morning to you. Longest weekly winning streak of the year so far on the S&P 500. Equity futures positive here by 0.2%. That's the price action. Let's get to some morning calls. JP Morgan upgrading Carnival Cruise to overweight. $16 price target, seeing signs of strengthening demand and impressive booking trends. Next up, Evercore upgrading AutoZone to outperform, saying recent declines have presented an attractive buying opportunity. That stock is unchanged. And finally, Raymond James adding Southwest to its analyst favourites list, expecting shares to outperform as management addresses what they call operational issues. That stock is up by 1.4%. Coming up, Allspring's George Bory recommending investors go global and diversify beyond the US dollar. That conversation coming up shortly. Your equity market just about positive on the S&P through most of this morning. Your opening bell up next. The runway through this week looks a little something like this. CPI tomorrow morning, the Federal Reserve on Wednesday, going into it, longest weekly winning streak of the year so far on the S&P. Futures positive by 0.2% going into the opening bell. Just a subtle shift in the last couple of weeks, month to date through June so far. Some outperformance in this one. The Russell and the small caps, the banks, the regionals starting to make somewhat of a comeback. There's your opening bell. Switch at the board and get to the bond market. Yields look like this on a 10-year, down almost a basis point, 373.17. The euro showing a little bit of strength, just short of 108 at 107.67. Positive by, let's call it 0.2%. And look out below crude, 67 handle, down 3%. Not what Riyadh and OPEC Plus wants to see. 67.95 on WTI, and a downgrade, a cut to the outlook from Jeff Curry and Goldman over the weekend too. One stock to watch at the open, it's Nasdaq, the second largest US stock exchange, agreeing to buy financial software maker Adenza for $10.5 billion. The CEO saying this: with this deal we can offer an even broader range of mission critical solutions that enhance the liquidity, transparency and integrity of the world's financial system. Abby has more. Hey Abby.
Hey John, and all that may be true, but with the stock having its worst day right now, at least since March of 2020, investors not perhaps agreeing in the near term relative to this this decision. Now, Adenza, they offer financial services software to hedge funds, banks that help with regulatory functions, among many others. The CEO of Nasdaq, Adena Friedman's talking about the idea that they want to create a revenue base that's going to be less volatile than that of the exchange. However, to get there, there's a little bit of smoothing over here. It will be, in fact, their biggest acquisition of all time. Adenza right now, last year, had $590 million in revenues. They also have more than 60,000 users. So for the longer term, John, it seems as though the promise is there. It is, of course, they're buying Adenza for $10.5 billion from private equity investor Thoma Bravo, which in this deal will actually have a pretty big stake in Nasdaq. So again, it seems like the long term is positive, but right now the stock down 9.1%. Investors having a hard time getting their heads around it.
And just to be clear, anyone tuning in, that is the stock, not the index. The Nasdaq is down by 7.8%. The index, the Nasdaq, is positive this morning by 0.4%. The S&P 500 up by 0.2%. Abby, thank you. Another stock to watch, Biogen. Shares jumping after the company's Alzheimer's drug gained support from FDA advisors. An analyst over at SVB Securities saying, quote, now that Biogen has crossed that finish line, we look forward to additional transformations in the coming months. Isabel Lee has more. Hey, Isabel.
Hi, John. Shares are up around roughly 3%, and that's after it gained support from all 6 FDA advisors in a discussion that took around 20 minutes, actually, and they're expecting the drug to gain the full regulatory support. So this is the first treatment to clearly show that a slowing in progression in Alzheimer's disease, which is a disease that affects around 6 million Americans, roughly 55 million people around the world. Stock is up around 12% so far this year, and shares were halted Friday ahead of the meeting, John.
Stock is up 2%. Isabel, thanks for that. Also looking at shares of Oracle this morning. Wolfe Research upgrading the stock to outperform ahead of earnings after the closing bow. The analyst expecting its cloud business to, quote, become the engine that accelerates top and bottom line growth for the company over the next 3 years. Kaylee back with us with more. Hey, Kaylee.
Hey, John, certainly an acceleration for the stock this morning, up more than 5%, trading at a new record high. Again, Wolfe is expecting in the years ahead they are going to see that acceleration in the sales and earnings growth. Optimistic that their plans to use Cohere to sell large language models are going to pay off for the company. So really, this is another AI play here, John. Piper Sandler has previously written that when you look at the AI and cloud tailwinds, that could mark a beginning of a new era for this company. And that was really what has propelled a rally in this stock up, leading up to the earnings today. If you add today's gains to the total for the year, up 41% year to date. Still, though, the stock is only trading in the forward multiple of about 21 times, so still a lower valuation than some other AI plays like NVIDIA, for example, which could make it relatively more attractive. As for what we're expecting in those results due after the bell today, John, earnings growth of around 2.6% is the average analyst estimate, while revenue growth is expected to come in near 16%. But again, for this company, it may be more about the forward-looking view and ultimately how AI is going to factor in and really propel things forward for this name, John.
The buzzword of the moment, Kaylee, thank you. On the session, that stock, that name is up by almost 5%. Dan Ives of Wedbush expecting the big tech rally to continue as the AI push gets bigger. He wrote this: while this week the Fed and Powell yet again will be front and center, in our opinion, the tech sector is in the early stages of its next growth cycle that will be led by this unprecedented AI revolution. Many companies will benefit in this arms race, with Microsoft a clear market leader, along with guess who? NVIDIA. Dan Ives of Wedbush there on a tech rally. Some of these names year to date have been absolutely flying, including Tesla. Shares edging higher for a 12th consecutive day, marking the longest winning streak on record. KGI upgrading the stock to outperform, saying this: Tesla's automotive investments in the US are paying off. Its AI prowess is underrated. We're up by another 1.75, up another 1.8% this morning, Katie.
And if that holds, of course, that will be that 12th day of gains, which is a record winning streak for this stock. And there's a few different things that got us here. Fundamental reasons, too. Most notably, in the past few weeks, you've had the likes of Ford and GM saying that they're going to adapt their EVs to hook into Tesla's superchargers. Piper Sandler thinks that's worth a $3 billion boost by 2030 or so. And not to mention, you also have Tesla's Model 3 sedans became eligible for the full U.S. tax credit. So again, a few different fundamental reasons to go along with what's been a blistering rally. If you look at today, again, we're up almost 2%. This rally, if you look over the past winning streak that we're sitting on, It's added about $200 billion to Tesla's market cap. This company is now up over 100% so far in 2023 to go along with that record. So it's been a pretty good summer so far for Elon Musk.
Amazing. And the wins keep coming. Katie, thank you. Katie Greifeld on the latest on Tesla. The winning streak continues for the broader market right here. About 6 minutes into the session, the S&P up by 0.2%, the Nasdaq up by 0.4%, 48 hours away from a Federal Reserve decision. Here are the scores since Chairman Powell and co. last met. The S&P 500 up around about 5%. The two-year yield climbing something like 80 basis points over that period. The US dollar stronger by almost 2%. And as Eric Robertson of Standard Chartered explains, US exceptionalism has crept back into the conversations we're all having. He suggests markets are losing faith in the FOMC's ability to bring down inflation and in China's ability to engineer a sustainable economic recovery. We believe, he says, that markets are too bullish on the US, too bearish on China. Joining us now to discuss is Allspring's George Bory. George, can we start there? And it's good to see you, as always, mate. Do you think we are too bearish on China, too bullish on the US?
Well, John, as you mentioned, well, first off, thanks for having me on the show. But as you mentioned, big moment in time for this cycle as we come up to this week's Fed meeting, and big question marks about sort of what the Fed's going to do sort of longer term. But right now, many investors are expecting a skip or a pause, but at the very least for the Fed to not raise rates this week, which really could represent a meaningful inflection point in the cycle. As you point out, what's happening globally is this sort of divergence in trend, whether it's the US, Europe, Asia, even in China. There's a meaningful divergence in trends happening around the world, and we're starting to see that manifest itself both in bond markets, as stock markets, and importantly, very importantly, in monetary policy. And we think that's what's ultimately going to be a dominant driver of performance, specifically for bonds, as we go into the rest of this year.
George, can you describe that divergence with a little bit more detail? What are you seeing that perhaps others aren't?
Yeah, well, when we look at bond markets in particular, at Allspring, we look kind of globally. We're looking around the markets for different yield opportunities, different divergences in prices, and ultimately trying to bring those yields back to sort of portfolios that we're managing. So if we look at things in dollar terms, if we invest in, say, Euro credit or, say, government bonds in other countries around the world, transport that back to the US into dollars, there's a pretty material pickup in yield. That yield advantage is very beneficial to portfolios. And you just talking about stocks, certain stocks are doing very, very well right now. Well, the bond market is just chugging along. We're doing well over the course of this year, kind of consistently providing sort of persistent income, persistent performance, and sort of bringing back kind of the returns that a typical bond investor is used to seeing. If we can bring those earnings from overseas back to the US into a dollar-based portfolio, we've diversified the risks within the portfolio, we've up-tiered the quality, and we think we've materially improved sort of the forward-looking or expected performance of that portfolio over the coming weeks, months, and perhaps even years.
George, help us all understand how you're managing the currency risk associated with that.
Yeah, well, when we look at, say, a bond and we want to swap it back to dollars, we can currency swap the portfolio so as to bring those euros back to US dollars. We'll buy a German bond denominated in euros and then swap the euros back to dollars. So there's two securities effectively attached to that one trade. That can increase the yield of that position by as much as 200 basis points or more in today's market. That yield advantage is very accretive to an individual or an institutional portfolio that's denominated in dollars. It's that type of diversification that allows us to take advantage of opportunities that both exist here in the US, but also outside the US, and bring it back into US dollar denominated portfolios.
George, if we can, just to wrap things up, let's really aggressively shorten the time horizon and talk about what's on the horizon for this week. It's the Fed decision on Wednesday. Pause, skip, hike, whatever it might be. Do you think that CPI tomorrow morning moves the dial in any way, shape or form?
Not for this week. We think at the end of this week, what we'll see is a Fed that's on hold, inflation that is showing signs of coming down, but to be fair, it's a lot to do with base effects, and a very mixed economic backdrop. That kind of leaves the window open for the Fed to both skip and perhaps pause. We think the next most notable point on the horizon is actually not until September 20th. There's a long time period between today and sort of the second meeting, the one after the July meeting, which gives the Fed a long window to sort of data watch, assess the economy, and determine whether or not they've sufficiently raised rates. We think we're going to be in a period of sort of what we would call kind of an uncomfortable carry period, where markets have to sort of wait and see as the Fed kind of digests data and we wait for that next moment in time. So we're looking forward to the next couple of months. We think bond yields will come down a little bit and spreads should sort of hold in. That should be a good environment for bonds. So at Allspring, we bring all these factors together to try and determine sort of how best to position portfolios. Like I said, diversification, a little bit of duration, extra yield means you should continue that consistent performance that you've seen this year throughout the remainder of the year.
Hey, George, thank you. George Bory there of Allspring. Looking ahead potentially to a fascinating summer or just a really tedious one, depending on how you view these things. About 12 minutes into the session, equities positive by 0.25%. I think this is a three-day winning streak on the S&P, on the Nasdaq up by 0.4. Coming up, UBS completing its takeover of Credit Suisse.
There are some culturally flawed European organizations, several that I worked at, but it's played out through the numbers, and it's relevant to my analysis of the U.S. banks now because Goliath is winning, and the Goliaths are the largest U.S. bank.
That conversation up next.
There are some culturally flawed European organizations, several that I worked at, but it's played out through the numbers, and it's relevant to my analysis of the U.S. banks now because Goliath is winning, and the Goliaths are the largest U.S. bank.
UBS completing its takeover of Credit Suisse, creating the biggest banking merger since the 2008 financial crisis. UBS formally announcing the deal in an open letter saying, quote, "We will never compromise on our strong culture, conservative risk approach, or quality service. Many are counting on us to make this acquisition work." Bloomberg's Marian Hofdemar joins us right now. Marian, can I just pick up on some words that the UBS chair, Com Keller, has used? We are worried about cultural contamination. They're not exactly rolling out the red carpet, are they, for Credit Suisse staff?
No, not exactly. There's been a lot of conservative words around Credit Suisse staff and the way Credit Suisse has managed business from UBS's chairman and CEO, and that's not exactly very welcoming for a lot of the colleagues across the street. And again, you know, today when we had the announcement of the merger close, we also had a swath of new executive changes, and we're seeing that not a lot of Credit Suisse employees have gotten these high-level positions at the new combined bank. So that tells you a little bit about how UBS is viewing their counterpart that they've just acquired.
Marian, do we have an idea of how big these cuts might be going forward from here?
It's a little unclear. They have said that they're trying to do $6 billion of cost savings that are related to job cuts. So you can do a little bit of math if you want to on average salaries. But it will definitely be in the tens of thousands. That will depend a little bit on the Swiss domestic bank and whether they merge those entities. If they merge those, then there's a lot of overlap. If they don't, then there could be a little bit more jobs saved there. And then we'll have to see going forward what the necessities are, because there's also been a lot of people just leaving of their own volition.
Marian, how focused are the Swiss government on making sure that this closes without scandals, given that they might have to pay up the cash if things go wrong?
I think they're keeping a very, very close eye, and they have said, you know, they have a seat at the table, in particular for the assets that they have guaranteed a potential backstop if the losses reach above $5 billion. So they will be sitting at the table watching UBS wind down some of these Credit Suisse assets, and we'll be monitoring very closely as the merge and the integration continues over the next 4 years to make sure that UBS is doing things in line with their thinking and also eventually meeting regulatory requirements. For the moment, they've been given reprieve, but eventually they will have to meet stricter and more stringent regulatory and liquidity requirements because of their size.
Marian, thank you. Marian Hofdemar on the combination between UBS and Credit Suisse, and some scathing words, really scathing words coming from the UBS chair, Com Kelleher. We're worried about cultural contamination. Imagine working for Credit Suisse, going through what you've been through over the last couple of years, working for that bank, and then you see words like that. Cultural contamination, a bank that's culturally challenged. I think we all understand that they've been through some scandals and some people are responsible for that. We also know some really, really good, fine people at that institution that have to wake up to comments like that over the last month. That's UBS and Credit Suisse. Merger Monday continues with two more deals, one in the mining space as Glencore makes a bid for the coal unit of Teck Resources, and one in the tech space with Nasdaq agreeing to buy Adenza, a financial software maker. Bloomberg's Katie Greifeld. Katie Lyons back with us. Hey, Kaylee.
Well, John, when we look at Nasdaq right now, down the better part of 10%, heading for its worst day since August of last year after the news that it's buying Adenza. This, of course, is the software company that helps exchanges, other financial institutions manage regulatory reporting, risk management, and compliance. The price tag is $10.5 billion in cash and stock, but also Thoma Bravo, the private equity firm that owns Adenza, is going to get a 14.9% stake in Nasdaq and a board seat as part of this deal. So maybe that's contributing to the decline today, but over the longer term, this is really part of Nasdaq's desire to expand in the software space. It right now makes up about a third of annualized recurring revenue, and Adena Friedman has characterized this as another way to diversify revenue away from just the exchange. With this acquisition, Nasdaq expects to increase its solutions businesses to 77% of total revenue from 71%. That is, of course, assuming that they get the requisite regulatory approvals, and if they do so, they expect this thing to close in 6 to 9 months, John.
That's Nasdaq. Katie, let's talk about Glencore. They're making a move.
Making a move. They're still pursuing Teck, now focusing specifically on Teck's coal business. Of course, this narrowing of focus comes after the Canadian miner has repeatedly rejected Glencore's $23 billion total takeover bid, but Glencore says that still offer full stance. But now this specific proposal would have Glencore buy the coal unit for cash, no valuation given, combine that with its own coal assets, and then create a separate company within a year or two after paying down debt. Now, Teck did confirm that it's engaging with Glencore and other parties, so this is far from a done deal. Deutsche Bank did say that Teck selling its coal business to Glencore would be attractive middle ground for both companies. But you can see the stock market reaction is a little bit interesting here. You have Glencore higher, Teck lower. Typically, it's the acquirer that falls and the target that rises, but a little bit of a flip-flop in that dynamic today.
And Katie, thank you. Almost 10 years to the day since Glencore finished its takeover of Xstrata. They were the days when Glencore used to be front page news with their acquisitions. Katie, thank you again, alongside Katie Lyons. Thanks for that. Took a while for the camera to get off, Katie, but Katie, thank you. Let's get to Abby and get you some sector price action. Hey, Abby.
Hey, John. Not a lot of drama here for the sectors for the S&P 500. We have a majority higher, but none by more than 0.7%. In fact, more specifically, we have consumer discretionary up about 0.6%, followed by tech and communication services. So it speaks to a little bit of a rebound for those mega cap tech sectors. The lagging sectors by about 0.3% or less: real estate, energy, utilities, consumer staples, and materials. But let's check back in on what we've had happening this month with small cap and banks leading. And we can see that the Russell 2000 ETF up 5.5%, regional banks up 9.3%, the tech index up 1.4%. At least it's not a decline, but you can see that massive spread between small cap and tech along with the SOX. And what makes that SOX interesting, that the fact that it's lagging, John, that's everything AI. The banks really have it this month so far.
Abby, thanks for that. The latest, of course, from Goldman Sachs is getting the headlines from David Kostin this morning around the opening bell. The upgrade to their price target, 4,500 from 4K. If you spend some time reading the note, reach out to the team. I'm sure they'll be able to help you over at Goldman Sachs. They're basically saying that their earnings forecast is unchanged. This is all about multiples from their perspective, which makes the pushback from Mike Wilson and Morgan Stanley curious this morning, because this is what he's got to say. With the S&P 500 rally now crossing the 20% threshold, more declaring the bear market officially over, hence the 20% move. We respectfully disagree due to our 2023 earnings forecast. Mike's been bearish and right last year, bearish and wrong this year. Sticking with the earnings forecast for 2023, he is forecasting some pain ahead. Your opening bell about 23 minutes behind us. Equities up by about 0.3% in front of us. Your trading diary. That's next. 26 minutes into the session, positive here, up by 0.3% on the S&P. The Nasdaq up by 0.5%, and the Russell, the run there continues. That's the price action, your trading diary. Big week ahead. Oracle reports after the close. US CPI tomorrow morning. Fed rate decision on Wednesday with a news conference and forecast too. ECB on Thursday. Jobless claims, retail sales. You know all of that. BOJ on Friday. And we round out the week with the UBS Consumer Sentiment Survey from New York City. That rounds out the morning for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.